Hey everyone, it's Mark, your firefighter, realtor, and out-of-state investor. Today I have a special guest on, Ryan Bakey, and you probably all know him on social media. He goes by Learn Like a CPA. And welcome to my show, Ryan.
Hey, Mark, thanks for having me on the show.
Yeah, man, thanks. I know you're super busy. We're going to try to bang out some great topics here, but why don't you give my audience a little backstory about your history, your portfolio, and whatnot.
Yeah, so I had an accounting and finance degree. That's what I went to school for. So understanding pro formas, projections, past financial performance has always been a strong suit of mine. I went to work at Deloitte Consulting for a few years out of college. I did investment management for hedge funds, real estate syndications, and then private equity groups. And it was there where I realized I was helping people who are already rich and wealthy become even more rich and wealthy. And I wanted to help the person, not the everyday person, but I want to help the person in their family that was going to change their family tree. And so that's kind of when I started to learn like a CPA brand as well as my CPA firm. And we focus only with real estate investors primarily to help them build wealth, primarily through tax strategy, but then also just thinking a little bit differently out of the box, whether that's I'm really big on the cash on equity audit right now. A lot of people got equity in their properties, but interest rates are 7-8% now, and what do you kind of do kind of stuck? And that's kind of what my firm overall has helped people with, is not only the tax strategy piece of it, but also just the overall, how does that affect your portfolio? And so I have a CPA firm. I do real estate education, so I teach people how to run pro formas and tax knowledge through my academy and coaching programs. And then I also have real estate deals myself, so I've done single family home rentals, short-term rentals, and then recently RV parks and glamping tents too.
Oh, glamping. We might have to bring you on another time and talk about that a little bit.
Sure.
But the funny thing is I also have an accounting and finance degree, but I've never gone down that path and I have never actually used it. So I'm sure I'm definitely going to
Mm.
learn a lot. Yeah, I went down that path and it's just something I never stuck with. But talking about your journey, there was something that caught my attention when you were on social media. You kind of mentioned it a little bit about in the beginning. You were doing returns, I think, or helping clients, and you noticed a lot of them had real estate in their portfolio. So were you investing in real estate before you started seeing these clients and whatnot, or is that kind of what propelled you down this path?
I definitely saw the benefits of it before I even owned rental properties. And I saw just how rich and wealthy people operate a little bit differently than the everyday person. I mean, even at Deloitte, there was a lot of these companies took out, they had balloon debt where they basically would be interest only for 15 years and then they would pay a balloon payment when the note was due. But a lot of these projects, they would add so much appreciation and value to the underlying real estate play. So that way, when it came due to pay the note, they would just refinance out of the note and into a different note or sell the property. They would never end up actually paying the properties off. They would just keep kind of adding value and refinancing. And so they just live on a different system than we do. And I really wanted to kind of understand that from a tax strategy, but then also just an overall wealth building perspective.
Yeah, that's definitely like a lot of people in Hawaii, they have a lot of appreciation and equity in their
Mm.
residence. And for me, I did like you're talking about using that equity, but I wasn't using it in the proper way. I was wasting it, buying liabilities, buying things that weren't appreciating. And when you're talking about like mindset and seeing what the wealthy do, it just totally changed my mindset on how I'm supposed to be actually using this equity to grow my wealth, and then I can start wasting my money, I guess, if you want to say, on buying liabilities, but getting that cash flow to pay for it down the road. But an interesting thing you kind of brought up is, and I finally realized this also too. Now, can you kind of touch on what is like the difference between like a tax advisor and a tax preparer?
Yeah, a tax preparer is somebody that is going to take everything that's happened in the past and put it all together and tell you whether or not you owe money or you're going to get back money. Most high earners, just because of the nature of their income, they might have 30 grand coming from this income stream or $50,000 from this K1. A lot of high earners, they end up they're always owing money, which isn't a bad thing if you're doing it the right way. But I work with so many people that make too much money that they don't understand throughout the year what are they looking at. I always tell people that poor and middle class families, they know how much they're going to get back on April 15th, versus your rich and wealthier families. They know exactly how much they're going to owe or get back on April 15th before the year's even over. They know ideally by October or November what their estimated tax liability is going to be, so that they have at least a month or a month and a half to plan around that tax bill. If they need to redo some things, convert money over to Roth and retirement accounts, or they need to buy more property or get invested into more deals, they have a month or two to be able to do that. And so that's really the primary difference between a tax preparer and a tax advisor, is that an advisor is going to actually help you save money, versus a tax preparer. As a tax preparer's job, they should do all that they can, but they're working on past performance, whatever you did in the past calendar year, versus a tax advisor is proactively working with you to save you money.
Yeah, that's a great point. And I think I also saw you mention this on social media too, how, some people, they kind of get concerned that maybe what the cost of a tax advisor is. And you kind of broke it down to how much money that you can actually save them, right?
Yeah. And that's what you have to look at it too, is the value. And that's really part of the proposition that I have with all my different products is, if I can't get somebody a 3 to 5x value of what I'm charging, I'm not even going to offer them. Because after working with hundreds of investors, I know within 5 to 10 minutes of talking to somebody how I can step in there and provide value to them where they might not be looking at. And if I can't guarantee that I'll be able to save somebody $30,000, I'm not going to charge them what I charge. And that's really, and then maybe they're not able to save $30,000 based on the situation. Maybe they're only able to save $5,000 or $6,000. That's where my podcast or a free course or a training that I have that might only be a couple $100 comes in. Because if you take a $300 class of mine, but you learn how to save $5,000 a year for the rest of your life, I think that's money well spent.
I think a great point too is tax advisors are a little more forward thinking, right? Like you're saying, tax preparers are looking on past performance, and a tax advisor is going to kind of almost like plan out your future to some extent.
Yeah, and that's really what it's about, is playing not doing a Monday morning quarterbacking where you're looking back on what happened, but you're proactively planning for the future. That's the difference between, a tax advisor or a wealth advisor, and then somebody that's just going to tell you, oh, this is what you should have done versus this is what you can do.
I love it. So a lot of my topics, like I said, I follow you on social media, and I see a lot of great information you're putting out there. And another one, that caught my attention was you were talking about like passive income and how, Donald Trump and his tax returns, and how he was kind of legally able to pay zero or to no taxes.
Mm-hmm. So that's an understanding of knowing that it's not about how much money you make, but it's how you make it. It's the vehicle and shape of form. And the IRS has done studies on this, right? You could have person A, person B, they're both making $500,000 a year. But if person A is a doctor making that through their W-2 versus person B is making $500,000 through real estate, they could both be paying a totally different amount of taxes. The real estate investor could be paying zero, versus that doctor, if he or she is single, making $500,000 a year, they're probably shelling out $150,000 in taxes for that year. So it's not about how much money you make, but it's the vehicle of how you make it, right? Earn versus passive, because the tax laws are written for people that are business owners, are investors, or own real estate, right? It's Congress that writes the tax laws. The IRS just enforces them. And then when you look at who Congress is, it's business owners, real estate owners, and investors, right? So they write the tax laws that are favoring those types of activities. And the former president just so happens to own businesses, investments, and real estate. So no wonder he pays. And there's a quote, Warren Buffett's been known to say that he pays less in taxes than his secretary does. And it's not that he dollar amount wise, he pays way more in taxes than any of us, but from a amount of taxes that he pays relative to how much he's making, what's called his effective tax rate is way lower than us, right? So he might be still paying $10 million in taxes, but he paid that on $1 billion worth of income. He's paying 1% effective tax rate versus I'm paying 15, 20% effective tax rate.
Yeah, I think that's what gets people, upset, is when they hear like you're saying, he may quote it as saying he pays less than his secretary, but like you're saying, it comes down to the tax rate, and it's not actually the amount, because he's amount wise, he's paying a lot more than his secretary. But a lot of people, they get, upset about that. But yeah, like you said, it's not how much you make a lot of times, it's actually how much that you're able to keep. And that's great advice. Something else I kind of want to touch on, and especially being in Hawaii, we do have a lot of people that do short-term rentals here. And even though they are cracking down on it here, there's a lot of places that you still can do legal short-term rentals, nightly rates. Can you kind of touch on, that people talk about that short-term rental loophole?
I would say over the last 3 years, short-term rentals have blown up. And primarily it was because originally with the low interest rate environment, as well as people are able to buy short-term rentals using what are called secondary home loans. So they're able to acquire them with as little as 10% down. And from a tax perspective, it doesn't matter if you put 10% down or you buy it all in cash, you still get the same tax benefit. So ideally, the less money that I put down, I'm going to get the same tax benefit. It would be beneficial to just put as little money down as possible. But low down payment, you get to be a host, not a landlord. You get to own a property where you actually want to stay at. And then the tax benefits for short-term rentals are just way better than that of regular single family homes or multifamily. And it's because short-term rentals are taxed like business activities, not necessarily rental activities. And so in short, you could actually use the loss from the short-term rental, which is a paper loss. It's not actually a cash loss. And you can use that loss to offset your high W-2 or 1099 income. And when you look at that from that perspective, I just analyzed a deal for somebody earlier today where their cash on cash return was 15% investment wise. But when you added in that they were going to save $45,000 in taxes, it actually goes from a 14% cash on cash to a 60% cash on cash in year one. And in Hawaii, I would say Hawaii specifically, super high purchase price. So, and it's going to be high income folk. So they're going to save a lot of money on taxes. The only thing about Hawaii to watch out for is the land value, because you only get depreciation on the building value. So if I bought $1 million property in Hawaii where the land there is worth 50%, I'm only going to get half the tax benefits as if I bought something that's $1 million in, let's say, the Smoky Mountains, where the land isn't worth a lot of money. Where you invest is very important. Now, that's not to say don't buy anything in Hawaii or on the ocean or places like California. If it makes money, go ahead and do it. But you can strategically invest in places that will give you more tax benefits. So for example, maybe not say no to Hawaii, but think about doing condos or townhomes or HOAs, because you normally don't own the land that the condo or the HOA is sitting on. But if you have a single family home and you own the land, if you're in Hawaii, I mean, the land value is probably 40% of the total value, maybe 50%.
Interesting. So that's kind of how it's like with leasehold property. Is that kind of the same
Mhm.
thing where if you own it through leasehold, are you still going to get some of these tax benefits?
The leasehold properties, if you don't actually own the property or the building, you do not get the depreciation for it.
Okay.
So a lot of people do what's called Airbnb arbitrage, where they'll rent from a landlord and then re-rent it to other people. The problem, not a problem, but the disadvantage to that is because you don't actually own the building, you don't get the depreciation and the tax benefits of doing so.
Okay, that's great to know. All right. Well, yeah, those are a lot of the big topics. People are very, like you're saying, short-term rentals blew up the past few years, active, passive losses. I also want to get into, I know you're super busy, but I want to give you this opportunity for some like selfless promotion and like where people can find you. And you kind of mentioned you have classes, courses, but how can people find you?
Yeah, it'll be Learn Like a CPA on all social media platforms. So Twitter, Instagram, TikTok. It's going to be Learn Like a CPA. I still respond to all my messages too. So if you message me, it's not going to be a bot, I promise. And then I also have a Facebook group called Tax Strategies for Real Estate Investors. There's over 67, I think 6,900 real estate investors in there engaging daily. So that's been a good lead source and just a good place to add value to people.
Don't you have like a newsletter and stuff that goes out and things like that?
Yeah, so you'll be able to get on the email list if you tap into the Instagram or the Facebook group. I kind of get your email that way, and that's kind of how you can get engaged in some of the free tools. So one of the tools, actually my most downloaded, is probably my pro forma or my rental analysis for both short-term rentals and long-term rentals. So I teach people for free I call it a litmus test, but the thing is that math works in every single state, no matter where you're at. Dave Ramsey actually says that all the time, where math works no matter where you're at. But if I have a short-term rental, if I could take the purchase price, I recommend 15 to 20% times the purchase price. That's how much you should get in gross revenue. So if I have a $500,000 property, I need to be making between 75,000 and 100,000 in gross revenue. That's like back of the napkin, number one. Number two is an operating expense ratio test. So most of the time, if it's your first deal, your operating expense ratio, which is how much you're spending on like cleaning, supplies, furniture, that should be about 35 to 40% of whatever you're taking in gross revenue. So if your gross revenue is 100K, then your operating expenses shouldn't be any more than 40,000. So then you're left with 60. Now it goes to test number 3, which is called the debt service test. Well, your debt service, the amount of money that you're paying in principal and interest, should be no more than 35% of the monthly gross revenue. So if I'm getting $10,000 a month in revenue, my mortgage payment should not be more than $3,500 a month. If you can check those 3 things before you go to do a deal, you will get at least a 20% cash on your investment every single time if you can check those 3 boxes off. And again, like I said, the math works in all 50 states.
And you said this is free information you give away?
It is free for everybody. I give away stuff for free that's better than stuff that people charge for.
Yeah, I agree. I mean, I see a lot of your stuff and I love following you. And that's why I recommend everyone to go check you out. If you're not, like you said, you're offering a lot of free stuff, great value. And now before we go, as you can see all the superhero posters, my son, but I want to know, is there any superpower that you think you have that has helped you in your, real estate investing journey, or even on the tax side? Is there something that helps you survive, I guess?
I think the superpower that I would have is taking information that's extremely complex to understand, like the tax code, like doing pro formas, and breaking it down to a level that everybody can understand. So I take things that are super detailed, high level, complex, and I try to boil it down to something that everybody can understand. And that's the superpower that's helped me make a lot of money and influence other people.
That's awesome. I've started managing Airbnb properties. Do you self-manage your own short-term rentals, or you outsource that?
Good question. So I don't self-manage any of my properties because of a metric called ROH. It's called return on hassle, or return on haggle, some people call it. And so if I'm saying, hey, it costs me $20 an hour to manage a property, but I could go and make $50 an hour in my business, I would rather hire that out and take advantage of my time. So I don't self-manage any of my properties, just because the highest and best use of my time is doing things like this or working in my business.
Also, I was going to say your superpower would have to be patience, because that's what I'm finding out managing these short-term rentals for other owners is, man, you got to have some patience with some of these guests, man. Some of the questions and requests that I get.
Mm-hmm.
Yeah, but thanks. I know you're super busy. Thanks for coming on my channel, and maybe we'll catch up again, on some other topics, but thanks, Ryan.
Yeah, we'll have to do episode number 2.
All right, man. Thanks.